Hello friends, last week we saw the market really go through the roof and Nifty scaled Mount 20,000 just as I had indicated in my previous week's video. But there was another noteworthy thing that happened last week which I think my online family needs to know extremely urgently. You see, Bill Gates, the founder of Microsoft Corporation, once famously remarked in the 1980s, 256 kilobytes ought to be enough for everybody. He was talking about the RAM, random access memory, for his desktop computers, the first generation desktop computers that would run his disk operating system or DOS. Now, you have basically seen technology go up by leaps and bounds, and today your mobile phones have 12 GB, gigabytes, not kilobytes, gigabytes of RAM. So that's the kind of technological advancement that has happened in telecommunications. Back in the day, when we guys used to program our statistical trading models, the norm for many decades was 2 standard deviations ought to be enough for any statistical systems trader. Now, standard deviation is a measure of how much intraday ranges stock prices fluctuate by. Now, 2 standard deviations ought to be enough for majority, I would say more than 90% of traded securities. But last week, I saw many counters go to 3 standard deviations, 3.5 standard deviations, and even go to the kissing distance of 4 standard deviations, which means volatility has jumped through the roof. How do you tackle this volatility? This video is all about that, plus our usual in-house exclusive studies you won't find anywhere. Let's dive right in, and on your market roundup window, what you are seeing is that the rally was led by the bank Nifty for a change, which played catch up and outperformed the Nifty 50. The US dollar index, the Dixie, continued to rise. It went up by 28 basis points and exerted downward pressure on bullion. Sure enough, gold and silver fell. Natural gas also fell, but crude oil went up. Remember, I've been telling you that this is an output cut implemented by Saudi Arabia and Russia, and the man-made shortage thereby created is resulting in crude oil prices remaining firm. Also, the hurricane season in the US. The Indian 10-year benchmark bond yield fell by 2 basis points, which means bond prices rose a little, which was another reason why the bank Nifty gained. The Indian rupee eased against the dollar at 83.20, which last week was 83.07. NSE market capitalization went up a little over 0.75%. That tells you that the rally was fairly broad-based, and MWPL or market-wide position limits went up, which is routine after an expiry. Where the US markets are concerned, the headline Dow Jones Industrial Average rose marginally, whereas the NASDAQ, technology-heavy NASDAQ, and the broad-based S&P 500 fell. So it was a mixed bag, but overall, it was nothing bullish to write home about. Friends, I now come to in-house indicators. I start with MWPL or market-wide position limits. Now, this is the extent of limits utilized by traders as a component of the percentage limits allowed by SEBI. We are now at 38.21 in the second week after expiry of the August series. And we are at the highest in the second week after expiry in the last 5 months that are covered by this chart. So, risk appetite remained higher in the traders' camp. But this is one of the reasons why standard deviation or volatility went up. I have told you in my live mint columns as well as in my videos that a buildup of big positions will lead to more volatility, because one of the two, either the bulls or the bears, will surrender their positions, and whichever side surrenders their positions will square up very large quantities of open trades. And such large quantities, whenever they are opened or closed, price moves exaggeratedly, and therefore volatility goes up. So this is one of the reasons why standard deviation went well past the 2 mark. What we do need to see is whether the 40% mark, the magic threshold, which has been evasive for many quarters, is likely to be achieved in the September series. That would be some milestone to achieve. Friends, I now come to the stock and index futures turnover. Remember, these are concurrent 3 expiries, so September, October, November. The turnover went up, which means one Marshmallow traders have participated well in the week's optimism, and they have basically been they've basically displayed a higher stomach for risk appetite, which is advantage bulls. I now come to the advanced decline ratio, which after the price itself is the most leading indicator of which way the winds are blowing. The Nifty has clocked gains of 1.88% last week, and the advanced decline ratio went up from 1.28 to 1.31, which means for every 100 losers, there were 131 gainers. Here again, one Marshmallow traders have shown higher risk appetite. Friends, I now come to the prompt month futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Now, the Nifty basis has gone up by 1%, whereas the Bank Nifty basis has come down sharply. What does that tell us? It tells us that 2 Marshmallow traders, and the Marshmallow theory is explained in the link in the description below this video, as well as in the pinned comment below in a tutorial video that I have made in 2022. Basis for the Bank Nifty fell because at higher levels, 2 Marshmallow traders have unwound long positions and maybe even shorted a bit, whereas the Nifty basis has gone up because short covering took place at higher levels because bears are running for cover. Friends, I now come to our exclusive in-house indicator, the impetus, which you won't find anywhere in the public domain. What you are seeing is both the indices have risen for the second consecutive week in a row, and the impetus has also gone up across the board, which tells you that the rally was powered by forceful buying, which is again advantage of bulls, advantage going to the bulls. Now, for the LWTD indicator that you've been trusting for almost 1.5 years, and I update this on my social media accounts on a daily basis, do take the effort of connecting with me here. The LWTD indicator has fallen marginally to minus 0.07 from the prior week's plus 0.10. Although it's a very small decline into negative zone, but coming on the back of a week when the Nifty has clocked 1.88% gains, it tells you that relatively speaking, I'm talking of relative numbers, not absolute. Relatively speaking, fresh buying support at higher levels might just be a little lower. Short covering, yes, that could happen, but fresh buying might be a little lower. These are two different things. Short covering cushions the declines, whereas fresh buying triggers new highs. Friends, our in-house indicators done. I now come to the bond market, which I have been leading. Since many years, I've been covering bond markets ahead of equities, and I've been telling you that it is the bond market that fuels or finances the other asset classes. Now, Indian bond yields have actually fallen a little bit. We are still not below the 7% mark to trigger purchases into gilt funds, and nor are we above the 7.5, 7.60% to start laddering sovereign yields again. So we are still in a wait and watch mode, and only fall below 7% on a consecutive closing basis will trigger the next kind of step in our blueprint, which is gilt funds. Friends, the bond market's done. I now come to the Bank Nifty, which rallied on 4 out of 5 trading sessions, as you can see on the daily chart on your screen. What you are basically seeing is that the price is comfortably above its 1 month long moving average, and the moving average itself is turning upwards, which means the short-term outlook remains positive. Last week, I advocated a harmonic seahorse pattern on the Bank Nifty ever since the head and shoulder was negated. And I remember telling you that the target is 46,500 in the absolute near term. And there you have it. You came within a kissing distance of 46,500. The Bank Nifty actually went to 46,310. The Bank Nifty is marginally below the all-time high. And taking a look at the weekly chart, what you are seeing is that the Bank Nifty is comfortably above a 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is also positive. And look at the quality of buying. Last week's candle is significantly larger than candles made in many weeks. That is called a power candle. That tells you that the range has expanded onto the upside, and therefore 46,500 as a target still remains open and on the table. In the week before last, this index was number 6 on the most volatile counters list as per statistical beta rankings that we maintain in-house. It climbed 3 notches to reach number 3, which means the volatility has gone up. Do remember I told you standard deviation I saw expand very sharply. So it's at number 3, and that's a very high ranking, and retail traders might just find it challenging to garner profits here. Last week, I advocated an expected range between 46,250 on the upside and 44,050 on the downside. Well, it missed by 60 points because the high was 46,310. So the high was 60 points higher than where I expected it would be. In the coming week, I expect the estimated range between 47,350 on the upside and 45,125 on the downside. Let's be careful out there. It's going to be a volatile week ahead. Friends, the Bank Nifty done. I now come to the Nifty 50, which came in second with 1.88% gains. It was marginally less than the Bank Nifty's gains. But similar to the Bank Nifty, as you can see on the daily chart on your screen, the Nifty also went up on 4 out of 5 trading sessions. Price is at an all-time high. And as I had put it on my thumbnail on last week's video, Mount 20,000 on the Nifty has come and has been easily overcome. So when the high was basically overcome, strong hands absorbed the supply offered by weak hands very comfortably, and the price is comfortably above the month-long moving average, and the moving average itself is turning upwards. But the angle of ascent or the angle of the rally has been a little steep. So that means there could be a little bit of a consolidation out here, but the short-term outlook remains positive. The weekly chart on your screen shows the second week of strong gains. The candle has been big and prominent. That tells you that the bulls are basically showing signs of aggression. And the price is comfortably above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is also positive for a delivery-based investor. Like I said, the amplitude or the velocity of the rally has been higher than average, which raises the probability of consolidation or some sideways move before the next up move can occur. In the week before last, this index was number 9 on the most volatile counters list. It jumped 3 notches to number 6, which means the challenge level for retail investors has gone up marginally because volatility will be up. Last week, I advocated an estimated range between 20,200 on the upside and 19,475 on the downside. The high was 20,222, which means my resistance area was overcome by just 22 points. In the coming week, I estimate a range between 20,575 on the upside and 19,825 on the downside. Friends, do remember, I would still maintain that you trade carefully with stop losses in place, small exposure, because statistical beta and the inherent volatility has jumped through the roof. Also remember, the weekly range also appears to be wider because of the high base effect out here. Friends, I now come to the retail risk appetite by way of the percentage turnover contributed by each segment of the market. And what you are seeing on your screen is the daily chart where I show the index futures that are denoted as a red line have seen turnover go up by 2 basis points, and the index options that are shown as army green line have seen contribution go down by 14 basis points. Now, the index options are the most low intensive, capital intensive instrument to trade, because the margins and deposits required are the smallest, and also volatility tends to be low. So traders have traded low risk appetite instruments mildly lesser. Whereas the turnover risen in stock futures. Stock futures are shown as a red line. The turnover has gone up by 2 basis points. Now here you require the highest amount of margin and mark to market payouts. And where else have the turnover risen? It has risen in stock options. Now, stock options are shown as a purple line out here. So basically, stock futures and stock options are more volatile. They require more capital on the part of the trader to foot up as deposits, and this is where turnover actually rose. Along with the impetus, along with the MWPL, where risk appetite was actually higher, even the turnover in riskier instruments was higher last week, which tells you that retail traders are showing higher degree of aggression. Should this aggression persist, further upsides cannot be ruled out in the coming week. But some room for consolidation is always open. Do remember, statistical beta and standard deviation are up. Friends, I now come to what I would do in the coming week, and I advocated sticking to public sector units, PSUs, which worked fairly well last week. I will continue to stick to this formula. Why change anything that's making money so long? And oil marketing companies were something that I expected to go down. Even though the markets went up, OMCs went down. And as long as crude oil prices remain upwards, oil marketing company stocks might fall a little more. I had advocated that metal stocks might come down because metal prices were coming down on commodity exchanges. That unfortunately did not happen. As a matter of fact, the reverse happened. So frontline counters actually went up. So I would stay away from them for now. In the commodity space, I expect oil prices to remain firm, but the rate of rally, the rate of ascent or the climb might just slow down a little bit. Maybe even a little bit of profit taking might also be seen. Do remember what I told you about standard deviation. Here again, even oil has recorded increase in standard deviations. And volatility can spike because MWPL is fairly high in the market. So whatever you're trading, trade light, carefully with stop losses, and that would seem to be the right way to go forward. Now, friends, a small update from my part. As far as those 5 high beta gaining stocks, impetus gaining stocks, and 5 impetus losing stocks are concerned, they were not stock recommendations. I was just telling you where volatility has gone up and where volatility has gone down. You will trade in the direction whichever way the market was telling you. But it could be misconstrued as a stock recommendation. And looking at what is happening in social media, especially with SEBI regulations, even though I'm a registered research analyst with SEBI, I would, in all prudence and in abundant caution, would like to discontinue mentioning stocks, even from the statistical beta and impetus point of view. So please bear with me. From now on, even on my Telegram channel, I will not be updating individual stock volatility rankings from now on. Friends, I hope my videos are helping you decipher the market signals better. And before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And hey, help me reach out to fellow like-minded smart traders like yourselves by sharing my videos with your friends and social media groups, etc. Thank you for your patience in being with me in this video till we meet again in my next video. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable weekend. Take care. Bye-bye.